Are you ready for the end-of-year melt-up? We're through the elections, and seasonality tells us that the Santa Claus rally should be right around the corner. The best part? Technicals are all aligned with a bullish market and risk-on posture. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame chart, what do we see here from a candle structure and location perspective? In terms of candle structure, we've got a solid green-bodied bar that really speaks for itself. We've got a very strong close from the buyers at the tippity top of the weekly range, which I would want to reinforce is suggestive that, hey, these higher highs are getting price acceptance. The reason that this is important is because if you yourself believe this is a fake out, or if people are trying to convince you that this is nothing more than a fake out, let's play devil's advocate and talk about what a fake out weekly candle would have looked like. Something along these lines, and I would have been shouting from the rooftops, oh my goodness, watch out for the weekly trend reversal. Let's talk about why. Of course, this is the previous all-time high, and we need to acknowledge that if the election gap up was going to be faded, we would have opened up here, but then promptly driven in the downward direction. If an upper wick produced an inverted hammer on the weekly, and heck, even closed back down inside of the previous week's range, that would have been really indicative of a lack of price acceptance on the gap up and these higher highs. If we just snap back to reality, that absolutely did not take place. We've closed at the highest high in the trend count. It's a brand new all-time high as well. So it's a great segue into trend. Although there is no indication of a pullback looking imminent, if we were to pull back because we're sitting on the highest high we know, the weekly chart can afford to look for a higher low. And the ideal higher low here would be outside of and above the previous all-time high. Once again, I'm not saying this looks like a primary outcome, but if something like this took place, absolutely, a higher low here over 586, that's the previous all-time high, would preserve the trend count, and I would look for continuation in the upward direction. There's another level on the weekly chart that's still important. I'm not forecasting that it's in play for this week, but I do want to reinforce that with this brand new all-time high, coming from the August 5th panic gap down lows, notice that the 38.2, the VWAP cluster, its beautiful confluence with the breakout level from here. Once again, not forecasting this as a primary outcome, but if there was a 100% retracement of the move, and yet we held on to 565, producing consolidation that looks like this, I'd call it nothing more than a bull flag consolidation period, and over time, we'll look for continuation in the upward direction. Let's segue on over to the weekly volume profile. We'll zoom out here. It's not going to be much of a shocker. Of course, as we're moving into blue sky territories, the first major high volume shelf is, of course, the previous all-time high, 586. No surprises there. The next major high-volume node is 565. Once again, not a shocker there. This is reinforcing the ideas that we just talked about. I do want to talk about, though, some measured moves here. I'm going to go out to a 4-year chart just because I want to reinforce why this is the measured move we're taking. If I come from this low up to this high and the pullback low of this bull flag, the measured move here is around 610. The reason we're using point A up to point B and the pullback point C is because this rally from A to B is the first time since the sickness rally, of course, that we had broken back out to brand new all-time highs. So that justifies using that move as the measured move. 610 is the target. If we come on out to the monthly time frame chart, anybody who's been around the channel for a while now knows that we've also talked about the confluence with this bull flag as well, from the sickness lows to the previous all-time highs, 2022 drawdown lows as the bottom of the flag. It's almost spot on, 610 as confluence there for the same measured move. Now, it's a little outside of this week's expected move, so let's drop it to the daily chart and analyze that real quick. But it certainly could be in play, noting that the market's really been on a rampage. And even if you just look at the previous week's expected move, obviously we had catalysts with the election and the FOMC, but massive continuation outside of the upper bound. So this week's expected move is situated right here. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 606.56, implying a brand new all-time high and a higher high in the trend count that's bullish. If we're contained by the lower bound, the number's 589.78, implying a massive higher low, but not only that, it's also a higher low outside of the previous all-time high resistance shelf that we were just talking about on the weekly time frame chart. So the measured move here absolutely leans more bullish than it does bearish. And once again, you can see the weekly and monthly bull flag measured move is up around 610, just a little bit outside of the expected move here. There's really not much to read into other than the expected move and the trend here on the daily chart. Obviously, the trend is now straight back in the upward direction with a huge set of higher highs being produced, and now we can afford some sort of higher low pullback on the daily chart, which we've already described. The ideal line in the sand is just anywhere above the previous all-time high, and you'll note that to be 586, as we had mentioned earlier. I suppose we can slightly read into the gap and go from Wednesday. We talked about that in the Wednesday midweek market update. A new one would be the Thursday gap and go. So are there any signs of stronger sellers? Were the sellers even able to repair, relative to the election gap up, a minuscule gap? The answer is absolutely not. So stronger sellers are not getting active in this market. On the daily time frame, I would say either straight up continuation looks great. Any consolidation here over 596.25 looks great for continuation. If we break below that level, you could be looking for a daily higher low on the gap fill reversal, potentially a Brigade bolt back over 596.25, or heck, even if we get something that looks like this, be my guest if you want to try the short from A to B, but at point B, you guys know what I'm going to say, it's absolutely looking for a reversal off of that level. And now these reversals here, I'm just drawing in double bottoms, but they might look something like an inverted head and shoulders on the hourly. They might look like daily hammer candles. Any sense of buyers stepping up at 586, the gap closes here at 592, or consolidation over 596.25 looks really constructive for trend continuation in the upward direction. The only time where I would start to have larger concerns on the daily chart for some further downside would be something that looks like this. Now, if I just pause for a second and ask myself the question, does this seem like a high probability outcome into the coming weeks worth of trade? I think the answer is no. Not only is it very well extended beyond the lower bound of the weekly expected move, but as we'll see through the supporting evidence in today's episode, there's no indication whatsoever through the intermarket relationships that stronger sellers are getting active here. Heck, price isn't even telling us that stronger sellers are getting active here with the lack of any semblance of gap close. If we take this down to the hourly time frame chart, it's going to be a lot of rinse and repeat. Once again, we can read into the fact that on the Wednesday morning gap up, if stronger sellers were going to make a stand for a larger fade to the downside, you would have expected these first hourly bars to close extremely weak near the lows of the range. It simply did not take place. From there, Thursday's gap and go closes at the high of day, and Friday extends the rally to the upside. We've got some very nuanced levels in here that you could, again, maybe pay attention to. That consolidation over 596.25 looks really good. It's just an hourly bull flag, and then some sort of Brigade bolt over the all-time high unlocks blue sky territories. Again, be my guest if you want to try these scalps to the downside. I personally am of the mindset that this market is looking for pullback buys until proven otherwise. So I am not personally going to be aggressively shorting from A to B, no matter how good the setup looks intraday. This market is clearly signaling risk on, and I don't want to be caught on the wrong side of that. So if we do get this pullback, once again, the idea, as we had already described on the daily chart, might be looking for an inverted head and shoulders on the hourly. Then maybe you take it with some higher confidence with a Brigade bolt back over 596.25. That's a possible bullish idea here. I would say the only time where you could actually try a decent risk reward short without shorting directly into a key area of support is if this market gives us something like a look above and fail. So what might that look like from a drawing and pathing perspective? If the market opens on Monday, breaks out of Friday's high, and promptly comes back down into Friday's range with a lower high under Friday's high, something along these lines, that would be a look above and fail that I might entertain for a possible short. The reason I would say that is because at that point, you would have trapped new money buyers who got involved at the worst possible location. A lower high underneath confirms that those buyers are unable to get back above water, the breakout traders at least, and maybe risk reward wise, you could pull off a trade that looks something along these lines. It's a little optimistic and it gives a little bit of disregard to 596.25, which I think is a decent level, but something along these lines is the only stronger short I could envision if there's a failure to continue higher early on in the week, and here's the key, with a clear and obvious entry point lower high back down inside of the previous day's range. Aside from that, it's pullback buys and bulls on parade looking for continuation in the upward direction. Let's go ahead and throw on the intraday anchored view apps just to take a look at what's happening from this perspective. And what I really just want to call out here is that over time, these anchored view apps will play catch up to the previous all-time high at 586, reinforcing the daily higher low pullback by when and if the market were able to make it there, right? So that 586 is being reinforced. We could also come in with a Fibonacci from the low of Monday up to the high of Friday, and the 38.2 honestly isn't that far off of that 586 level. So once again, reinforcing that level. And if we come in from the Wednesday low to the Friday high, what do we have here? Kind of sloppy, kind of random. I wouldn't read into these Fibonacci's too much. Let's take a look at the market internals for the NYSE. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Generally speaking, the most bullish posture of the market internals was actually on Tuesday, election day, and then intraday beyond that, things kind of faded off a little bit in terms of continuing the strength. Now, that doesn't mean the market's a short. It doesn't mean I'm bearish the market, but I did find it interesting that at the exchange level, the market really front ran the results of the election. Look at the strong volume inflows. This is where the advanced decline line was strongest on the week, and the cumulative tick was strongest as well. This is a 45-degree line. This is not just some sort of squeeze. This is actual strength at the exchange level. Now, as we look towards the end of the week, I would just sort of point out that consolidation or digestion of these gains is not unreasonable. You'll notice that volume inflows, were positive on Thursday, but nothing substantial. Friday, slightly lower. More of a sideways move here out of the advanced decline line. I think one of the largest tells here is what happened with the index score on Friday, completely flat. If you look at the cumulative builds on Wednesday and Thursday, flat. I would argue Friday is a decent show of strength from the cumulative perspective. However, we're not firing on all cylinders. We didn't have strong volume inflows here. We weren't pegged up higher in trend higher zone over 1500 out of the advanced decline line. So I want to be clear, this is not a call to say, oh my goodness, the market's going to consolidate and short and crash. You've already heard my thoughts on the market. It's risk on and it's very bullish. I think consolidation of the gains sets up the potential move for the next leg higher, right? That's really my take here out of the internals. So digestion, not unreasonable, but still bullish. If we look at the market profile for the ES, and if you're not familiar with this screen, check out the video tutorial in the top right-hand corner again. We've got ourselves continuation of value progressing in the upward direction. Here's value on Wednesday. Because of the sort of distribution of the way the market broke out, I can only fit Wednesday, Thursday, Friday on the screen without this thing looking crazy. So value progresses higher, point of control progresses higher. If there was ever an opportunity for a potential pullback, notice that on Thursday, value was it was literally centered in range. Point of control was at halfback, the purple line here. It's a very normal looking distribution, right? A normal curve. So on Friday, when we opened in range, just hardly at the top end of value, if the sellers were going to make a stand, that was their opportunity to get price acceptance here and possibly break down underneath the value area low. Oh, look at that. Drawing's not too bad. Breaking down below that produces overhead supply for a possible pullback. Did that take place? The answer is absolutely not. What do we have on the Friday session? What I actually would like to read into from Friday is a little bit, it's not a pure double distribution because you do have two prints here, an I and L period, but you do have this sort of zone, if you will, of thinner structure. So if the market opens up in this upper bound, I would be looking for continuation. If the market opens up in the lower bound, right, towards the midpoint of Friday's range, not unreasonable for more of that consolidation phase, digestion of the gains, a mild pullback. I really wouldn't say a major one, but a mild one. If you take a look at the value area from the Friday session, the value area low is completely outside of the Thursday range. Once again, this market is totally risk on and bullish, but I would use this as a very nuanced indication, either over or under about 60.28 in the ES futures for, okay, bullish continuation, or more so bullish digestion. Notice that I didn't say bearish consolidation, it's just bullish consolidation, right? So decent excess at the lows, decent excess at the highs. We don't have any poor levels to reinforce. Let's jump back on over to the platform and let's do it all over again for the nasty NASDAQ, kicking this up to a weekly time frame chart. And we'll take the same approach here. As always, I appreciate you guys bearing with me as I filter through some charts. So QQQ, weekly chart, weekly candle. What do we see in terms of candle structure and location? Very similar to the S&P 500. I would even argue lesser of an upper wick here, but the most notable part about the NASDAQ is, recall, there was some relative weakness on the higher time frames with the inability prior to produce an all-time high. That, of course, has changed And we did go on to produce a brand new all-time high in the NASDAQ, and we closed at that all-time high. It's not like we produced an upper wick and closed back down here. There was no rejection of this all-time high breakout. So far, so good. I would echo a lot of the same sentiments that we talked about over in the S&P. In terms of the trend count, it's up. If we were looking for an ideal high or low pullback, it's over that previous all-time high. Around 503.25 is the level. On the weekly chart, you could even bump it down a little bit, closer to 500 flat. 499, 500 flat. This looks pretty good for a weekly higher low in the count. Lows, higher lows, soft higher lows, firm higher lows. There you would have another great looking higher low to continue the trend in the upward direction. Larger concerns would only step in on the NASDAQ weekly if there was a larger breakdown underneath this 485 level. I would really start to consider this a major flush point, but just like the ES, the S&P 500, I'm not forecasting a 100% retracement of this move. If we find ourselves there, yeah, it's a threat, but it seems like lower odds as of right now. Let's continue along with the anchored view apps on the weekly, and we'll even come in here with the Fibonacci's from the bottom up to the top, and it's just reinforcing that cliff level, that flush point we were just describing, 480, 485, as a little bit of a weekly zone. If we go ahead and throw on the volume profile, we might learn a little bit more here, not much in terms of the breakout, right? Of course, the high volume shelf is going to be over the all-time highs, but this level is reinforcing the cliff. The break point, the flush point, it's that big danger zone, 480, 485. Really low probabilities that we go there this week, but something to carry forward if there is a larger reversal. Again, I think that that's lower odds. I want to be crystal clear about that. I don't want anybody to misquote me and say, oh, he's bearish. Look at this. He's talking about this breakdown point. No. Let's take a look through the lens of the weekly cup and handle, because this is not something that we've gotten to the full measured move from yet. If we come in from the base of the cup to the top of the cup, and extend that like that, right? We've already hit the measured move from the pullback low, but to the top of the cup here, the measured move around 520 is technically within this week's expected move. So let's drop it down to the daily time frame chart here. Let's go on over to the NASDAQ and we'll look at the weekly expected move. Here we have it. So there you go. There's that 518. That's the technical level that I was using. Again, splitting hairs, maybe 520 from a weekly perspective, but that's a possible upside target. As we're considering the expected move, though, here it is. Notice that the weekly measured move is in there. We have the upper bound at 522.88 and the lower bound at 505.42. Just like the S&P 500, brand new all-time high, bullish, higher high in the trend count, higher low if we were to pull back and respect 505.42. Even if we were to go a little bit further than that, notice that the previous all-time high we've got labeled here is 503.25. We've got a smaller bar on the Friday session out of the NASDAQ daily time frame chart here, which I don't think is a major concern, but it's something to at least acknowledge, right? You didn't get a strong close outside of Thursday's range like we did over in the S&P 500. So is it possible that if we are looking for some sort of short, if you're looking to trade the pullback to the downside, is it more possible that consolidation here turns into overhead supply in an easier fashion with a lower high under 512? I think the answer is yes, and we could still look for this gap close. But before we get, too far down the rabbit hole of like, oh, he's bearish, look at these, pullback opportunities talking about, let's again walk through the candle structure of what happened through the election. Big gap up. Was there any gap close? Hardly any. Is there any indication here of stronger sellers getting involved? The answer is absolutely not. Notice that we did not gap up to brand new all-time highs. We gapped up to the top end of what I was considering the daily balance range. If I just zoom back in on this with a little bit more finesse and do something like this, recall that the daily balance range was really something along these lines. So it was totally reasonable and even possible that the gap up here on Wednesday could have just faded off the top end of the range. We did not gap up to blue sky territories. Again, ask yourself the question, did that take place? The answer is clearly no, and therefore, I do not believe we have stronger sellers getting active in the market. Thursday gap and go, same ideas, same major themes as the S&P 500, now that we're trading at new all-time highs in the NASDAQ. Let's take it down to the hourly. We'll talk about some pathing here. As you can see, less acceleration on that Friday session as I just zoom in here. It's much more of a sideways session earlier on. Heck, you could even go as far as saying something like into the afternoon we attempted a breakout and closed back down further inside, quote, inside of the range, right? So that's a possible read that you could have here from the hourly. Again, it's not an overly bearish one. I would say if this just consolidates and Brigade bolts to the downside like this, you could look for the gap close, and that's under 512. The gap starts at 508.25 and closes at 506.50. When we get here, just like the S&P 500, the name of the game is how can we participate in higher lows to be pullback buyers. You could get involved on the double bottom, heck, inverted head and shoulders, as we've talked about. It could even just be a simple hourly hammer candle. You could get involved on the higher low back over 512 if you want more confidence. As long as the QQQ stays over 503.25, I think it's bulls on parade. I would say that there's a slightly larger danger in the sense that if this fails under the previous all-time highs and does something that looks like this, that gap close is absolutely an outcome that I would be trading for, just because we're slightly closer in proximity to the all-time high here, the previous all-time high in the NASDAQ versus the S&P 500. We'll go back to the hourly chart. We will throw on the anchored VWAPs intraday to be congruent in the analysis. Keep in mind that these will creep higher over time, so great. If they are confluence in this zone, I would absolutely be looking for higher low pullback buys, not new money shorts until there's a clear violation of that. And we can come in with the Fibonacci's as well. From the bottom of this consolidation to the top of the most recent all-time high, Fibonacci 38.2. You can't make this stuff up. It's literally right on the level at 503.25. It's right there. It's technically 502.98. You want to split hairs with me? We can split hairs, no problem. So there's that on the intraday. We'll take a look at the NASDAQ side of the market internals. What we'll see here is a similar style analysis to the S&P 500. However, Thursday's a little bit stronger in terms of the volume flows. Remember that the S&P, or the NYSE side of the exchange, I should say, was sort of more mild like this, whereas the NASDAQ was a little bit stronger and definitely got up and over the substantial read mark. If we're thinking about the advanced decline line, again, tapering off into the Friday session, which is not a shock considering the sideways activity we just talked about on the hourly chart, notice the flat cumulative ticks here and even the negative build on the Friday session. So a little bit more of that pullback being available on the NASDAQ, I think, is a reasonable way to interpret the market here. If we take a look at the NQ market profile, let's see what else we can learn. I really do just believe this resonates with exactly what we've been talking about, right? If this is going to turn into overhead supply, some sort of breakdown underneath the, Friday morning overnight low, that's possible. A breakdown underneath the Thursday value area low, some sort of move that gives you this Brigade bolt here, and you get much more of that thin structure retracement through the A period single prints, going back down towards that previous all-time high. If I just go back over here and talk about NASDAQ levels, or QQQ cash levels, it's 512, right? It's this exact idea happening here. Thin structure retracement. This is the A period single prints you just saw in the market profile, and then the gap below. So all of the nuances really align. Let's finish up the broad market with a look at the IWM cash ETF. What's going on? Weekly time frame chart to kick things off. What do we see here? Because this is a very impressive chart, and I think that this story is one of the stories that we want to focus on when we're thinking about the overall market narrative. Remember that this box represented hell, basically, for small caps. The market could not make up its own mind. Obviously, you had a lot of pressure there, downward pressure from tight financial conditions. Financial conditions, as we know, are loosening, and this breakout is confirming that market participants are seeing that same exact thing. The most important thing here on the weekly is the breakout and acceleration over this, what I would consider a weekly range that, we've tried to make some progress towards the upper bound, but this breakout last week is the final nail in the coffin for any shorts who are like, I think we're going to continue to pile into small caps. This breakout is the fuel to the fire to potentially give us new all-time highs in small caps, which speaks to a risk-on sentiment in financial markets. So this is a huge bullish tailwind for the S&P 500. It would be great to watch and see if the IWM can go on to produce new all-time highs as a result of this breakout here. If we're thinking about the weekly structure, let me zoom back in a little bit and get a little bit more nuanced. Obviously, solid green-bodied bar. I don't even have to draw it. It looks very bullish. You've got equal lows, massive higher highs, new high close, which means that once again, the higher high in the trend count affords a weekly higher low opportunity. I would really want to see this sustained price over 226.50 if we are going to remain bullish here on small caps, and if financial conditions continue to ease. That's kind of your line in the sand. Holding over 226.50 keeps the breakout successful, and will look for continuation in the upward direction, which helps the narrative for the bull case in the S&P 500. If this fails underneath, oh my goodness, I would start to sort of walk back some of the bullish sentiment that I'm currently spouting out and say, okay, if small caps are seeing something dangerous here, what are we missing in the S&P 500, right? So right now, it looks like operating conditions are easing, financial conditions are easing. That's leading and allowing this IWM to expand in the upward direction. In terms of our anchored VWAPs on the weekly chart, let's take a look. Obviously using this as a launch pad. Over time, maybe they start to creep up to offer support off the top end, but we're not there yet. So I would not call this a line in the sand. Our line in the sand really is the retest at that 226. If we come in here with the Fibonacci's from the bottom of what I would consider the range to the latest breakout, even the 38.2 is a slight undercut of these highs, and I would not like to see that tested. 226.50 is your weekly line in the sand. Let's drop this down to a daily time frame chart. We'll get a little bit more granular here on small caps, and then we'll move along. Of course, price acceptance gap and go here on the Wednesday session. Notice the lower wick. Sellers had their chance, completely failed, and we closed smack on the highs of that day's session. Now, I do want to point out a very subtle nuance here from Thursday in small caps. Thursday technically produces a bearish inverted hammer that looks above the Wednesday high and closes under the Wednesday open. If the sellers had an opportunity, if they were ever going to make a stand and possibly cause a larger pullback to, 227, 226.50 that we were just talking about, some more gap close, Friday was really their opportunity. They open in the lower portion of Thursday's range, but where does Friday close? Right back over 237.50, which it's not ironic at all. It's just the way technicals work. It's the high of day from what you're seeing here on that Wednesday gap up. But if I really zoom out, let me grab way more time here on a 5-year chart. Let's look left. 237.50 is also the neckline of this double top, which caused the market to break down, right? So the fact that Friday closes back above that level, I mean, you can see these overhead levels that we're aiming at. 240 is the lower high of the double top, and then it's straight to all-time highs at 244.46. If we just go back to the current price action, I, of course, would acknowledge that if we're underneath Thursday's low, yeah, this is a potential threat for some sort of move through the gap close. The line in the sand from the weekly that we were just talking about is really this prior pivot high, this, and this. And that's at 227. It's a partial gap close still at that. It's not even a full gap close all the way down to 224.25. So general sentiment in small caps, bullish, risk-on environment. Even if it pulls back, plenty of opportunity for a higher time frame, higher low. Let's drop it down to the hourly. And again, you can see that sort of look above and failure on the Thursday session, but Friday grinds right back to the upside and closes over that key inflection point we had just alluded to. So the pathing looks like this, bulls on parade looking for upside lift. If we come back down into range, I would be neutral through here, and together we could probably pick this off as a potential level around 236, I would say. Let's go 236 for round numbers only up here in the penthouse. There we have it. Let's actually make that a deeper gray and dashed. You guys know me, liking things to be a little bit uniform here. There we go. So if we break down below that, maybe there's some pullback, and maybe that offers some consolidation of the gains in the S&P 500, but I would not outright be a short in the S&P or the small caps unless there was a clear opportunity to rotate into the gap and offer better risk reward along these lines. If this is a trade that presents itself, great. It's a possible idea, but I would not just be swinging for the fences short inside of this gap up range here. That's 232.75 as the gatekeeper. It's also the lower edge of the weekly expected move, but that's the gatekeeper for the gap close to the downside, and 227 is that key daily support we were just talking about. Let's throw on the intraday anchored view apps. You're above everything, and the cluster here is quite nice. Confluence at that 236 we just identified, so all set on that. And if we come in with the fibs from the bottom of this move up to the tippity top, not really seeing any major confluences there. You maybe would pay attention to something like 230.50 with the anchored view app and the Fibonacci 38.2. Let's go ahead and move on into the market internals for the Russell side of things. And what we'll see here is a rinse and repeat of everything else, right? Obviously decent inflows on Tuesday, Wednesday, strong advanced decline line those days, and a little bit more of a mixed bag into the end of the week here and here. Same thing Tuesday, Wednesday, cumulative builds, mixed bag into the end of the week. So we've seen a very substantial move. There's been a huge expansion of range. Based on everything I'm seeing, right, it's very possible that just some digestion, some consolidation really sets up the next opportunity for continuation in the upward direction. But just immediately expecting it this week, we're sort of seeing the slowdown over the last 2 trading sessions. Let's finish up the Russell with, of course, a look at the Rusty Russell futures through the lens of market profile. And I think this is quite telling as well, where you really just have sideways value. Here it is on Wednesday, here it is on Thursday and Friday. Friday is maybe small progress for the bulls, noting that the point of control migrates slightly higher in the upward direction. Friday is an inside bar relative to the Thursday range as well. So small progress, but consolidation nonetheless. I really do believe that that IWM key level we just talked about, which on the Rusty Russell futures is maybe around 23.85. If that breaks, breaks, it could open the door for a pullback. But beyond that, it's just bullish consolidation until proven otherwise. Small caps are slowing down a little bit. Just keep that in mind when it comes to the S&P 500. Let's clear this up, go back on over to the platform, and take a look through the weekly performance of our S&P sectors as we went on to produce brand new all-time highs in the market. Who was leading, who was losing, and where was the weight? The XLY leads the pack thanks to Tesla, just an absolute mind of its own on that Friday session. 7.38%. The ETF, the sector, up 7.96%. You tell me who's responsible for that, Tesla or Amazon? Probably a combination of both. But very bullish, very risk-on. The XLY is a risk-on sector. It's the fourth heaviest weight sector by market cap. Then we have industrials up 5.92%, XLK technology 5.82%, energy's up there over 5%, semiconductors up over 5%, financials up over 5%. You tell me, is this a risk-on rotation or is this a risk-off, oh my goodness, be skeptical, it's going to be a fake-out market, it's going to crash and go to zero? Certainly the earlier, not the latter in that statement. At the bottom end of the barrel, nothing is red here, but the TLT is underperforming, only up 23 basis points. Consumer staples, which is a risk-off sector, only up 69 basis points. Materials, the lightest weight sector in the S&P, 89 basis points. Healthcare, D for defensive, but still the third heaviest weight, up 1.9%. You get the gist here. There's no concerns at the sector performance level. Let's take a look through these charts. Trading at or near all-time highs, the answer is yes. Bullish until proven otherwise. Ideal consolidation over to 1250 and continuation to blue sky territories. If it breaks down beyond that, yes, maybe intraday, intra-week bearish pressure for the S&P, but still have a clear opportunity for a higher low over the gap close at 203. XLI Industrials, brand new all-time highs, rinse and repeat. Consolidation over the previous all-time high or a gap fill reversal keeps the buyers in control here. There's nothing wrong with any of these charts. The XLK making an equal high to the previous all-time high, or just I should say the standing all-time high, but breaking out over the top end of this range. Recall from last Sunday's update video, we had talked about how this breakdown here wasn't unreasonable to change the trend out of the S&P. So I'm thrilled that as this move higher in the S&P itself has taken place, we're actually above the top end of that balance range at 234. Consolidation above that, Brigade bolts into blue sky territories, bullish for the broad market. If we come back down, the only time I would be concerned is if there is not a gap fill reversal. If we are under 227, I would wave the white flag and say, okay, something's wrong with the market. It certainly doesn't look like that's a strong opportunity based on what happened here into the end of the week. Small little consolidation inside bar on Friday. Next up, we have energy. Moving to the top end of its range. It's a lightweight sector. It's neither risk on or risk off. We'll keep an eye on it from an inflationary perspective, but if it breaks out over 94.25, a new pivot high in these lighter weight sectors is really what we care about. So watching that and bullish pressure is bullish pressure. Next up, we have semiconductors. What do we see over here? We were very, very, right at this level. How did we have this conversation, right? It was kind of tough. It was like, okay, can't really move the goalpost any further. This close on Friday of last week underneath this 245 mark didn't really give us a warm and fuzzy feeling. Where are we trading now? Just like the XLK back up and over the top end of the major range. 255.70 needs to hold consolidation here. That goes on to close the gap overhead, probably pressures the S&P to brand new all-time highs. Underneath 255.70 with a lower high would start to sort of dance a little bit more cautiously in the S&P 500. So really the tech sector and the semiconductor sector are top watches around these inflection points. If we take a look at the XLF, obviously with the whole idea of deregulation, mergers and acquisitions, the whole finance business is booming, or it's forecasting a big boom basically based on this massive gap up. You have some inside consolidation on Thursday and Friday. Very, very simple. It's obviously bullish for the broad market right now. Consolidation here keeps it bullish. Brigade bullets to blue sky territories, or heck, even a partial gap close reversal off of the previous all-time high, 47.75, would be a bullish outcome as well. If we were to fall underneath that and produce a lower high, I might be a little bit more neutral in my stance for the S&P 500. Next up, we've got communications pushing to brand new all-time highs. Once again, all of these heavyweight risk-on sectors are what? Concerning or not concerning? Certainly not concerning. Looks really solid up here near the all-time highs, new all-time highs. Consolidation up there keeps the bulls in control. Bullish Brigade bullets to blue sky territories. Not much more to comment on other than that. Heck, it could even go back down and close the gap around 93.20 and still remain bullish for a potential daily higher low. Let's move along to utilities, the most bond-like sector. Bonds did get a little uptick into the end of the week. We'll talk about a trade there in just a moment. But generally, the recovery back over the neckline, if you were to do something like this, is somewhat decent, right? Obviously, it's a risk-off sector for the market, but heck, upside pressure is upside pressure. If it wants to stay over the neckline and just consolidate in here, great. It's going to help the case for a more bullish S&P 500. As long as it's not the one breaking to new all-time highs as the market is, I think we're good from a posture perspective. Real estate, kind of sideways and lackluster. We know that the 10-year interest rate is still kind of booming, so not a shocker to see this underperforming. It's a really lightweight sector, not concerned with it. Here's the XLV healthcare sector. I love the fact that this undercut the previous area of support, right, from back over here, previous resistance as well, clearly, and now is trying to use it as support on Thursday and Friday. It is technically a D for defensive sector, but it's the third heaviest weight sector for the S&P 500. We can't really afford for this thing to be falling off of a cliff like it was over here. So the fact that this recovery is taking place, to me, is slightly encouraging. I want to see price continue to remain over 148, and that would continue the bullish pressure for the S&P 500, trying to spot something like a weekly or heck even monthly higher low on a major Brigade bolt for something that looks like this over the long haul. So watching XLV 148 this week. Next up, materials, very lightweight sector. As long as it's over this, not making a new swing low, we're all set. That's 93.60. We have XLP consumer staples, risk off sector. It's also very lightweight. It's recovered a little bit into the end of the week. Notice that it did produce a bearish engulfer on the Wednesday session. So to me, if any of the sectors was going to act poorly like that on Wednesday, this was the one to do it. And I'm not really overly concerned with what we're seeing out of the trend. The trend is absolutely down. Don't get it twisted, right? There are opportunities here for a lower high under 81.50, but because it's lightweight, because it's D for defensive, doesn't strike me as a posture issue for the S&P itself. Let's talk about the TLT briefly, because there is sort of this rebound happening over here on the heels of Jerome Powell's commentary, honestly, on the Thursday session, which we'll talk more about in just a moment. But this breakout level at 93, I mean, look left, there's some pretty thin structure all the way into, 96, give or take, 97, this gap close up here. What Jerome Powell basically reiterated in his press conference speech on Thursday was that, hey, bonds go up, bonds go down. I don't really care what they're doing in the face of my policy adjustments. He really just brushed it off. So hearing that, I think the bond market was like, okay, if you're not going to listen to us, then I guess we'll have to get in line a little bit. And that was that. I mean, you can clearly see the rally off of the Wednesday lows straight back to the upside, right? So that's one possible take here out of the TLT. But in the spirit of sticking with the S&P sectors, let's look at the ratio grid. What do we see over here? If you're not familiar with this screen, this dashboard, check out the video tutorial in the top right-hand corner on how to build it. The XLK looks fine. I mean, it didn't really go on to produce a new higher high in the ratio, but as long as it consolidates in this box here, if it can pressure the top end, I would still argue that's risk on. This, of course, is a not lightweight, but rather a defensive sector, so a downtrend here is no issue. If we look at the XLF, huge break on that, of course, Wednesday gap up, and the consolidation looks fine, holding for a possible higher low outside of the previous resistance over here, so that's risk on as well. XLY, the chart really speaks for itself, no issues there, that is risk on. Industrials even look fine here with a possible higher low over the 50 SMA. Communications look great with a ramping uptrend well above an upward sloping 50 SMA, which I get it. These are lighter weight sectors than the top 4 quadrant, but still risk on. If you look at the risk off sectors, no issues, no issues. Hard assets in real estate, no issues. More so sideways out of energy, not an issue from an inflationary perspective. All set. I really do think things are firing on all cylinders, I should say. Let's take a look at some specialized ratios. So top left is 1 to 3 year government treasuries versus the technology sector. Breaks to a brand new higher high. That, of course, is risk on. We'll put a check mark. This over here is utilities versus the technology sector. Breaking to a new higher high. That is risk on as well. If you look at discretionary versus staples, this thing's almost off the screen. It's literally off the chart. There you go. Huge breakout has to be more of a risk-on indication. And if you look at healthcare versus the semiconductor sector, or ETF, I should say, technically went on to print a higher high as well, room for a higher low. You're firing 4 for 4 on the risk-on specialized grid. One interesting note is that there was some China stimulus into the end of the week, and emerging markets sort of saw a little bit of an uptick, but couldn't hold the gains into the end of the week. Not the end of the world, but just calling that out as a potential consideration here. Let's move along to the dollar. Let's start talking a little bit fundamental. Obviously, on Wednesday, the strong move higher, some fears about trade wars, these tariffs that are supposedly going to be enforced here. So a stronger dollar, in theory, is going to pressure markets to the downside, but are we seeing any bit of that? The answer is no, and this is somewhat perplexing a lot of folks, if I'm being honest. It's somewhat surprising here. But if we take a look, I think it's the M&A sort of reduction of regulations that I think is counterbalancing that in the financial sector in particular. But let's take a look at gold, just as we're continuing to express things as currency, right? Relative to the S&P, this huge move to the downside to me would just indicate that, no, the market's not really fearful of getting into hard assets, being defensive, if you're thinking of gold as a defensive asset class. Huge underperformance actually, with a large move lower on Wednesday and just weak consolidation into the end of the week as the market extended the gain in the upward direction. So this to me speaks to a better risk on environment for equities listed down below. As we take a look at interest rates, they did back off, and we just saw the TLT breaking higher, so shouldn't really be a shocker here. But it just turns into a story of, is this a breakout? Is it going to be a successful breakout in higher low over 4.3 in the 10-year? As of right now, we did get a hammer candle to print on that Friday session here. So it is possible that this is still in play. I would say the best thing that could happen is that the 10-year just sort of pitters out and starts finding some acceptance under 4.3 going sideways into the end of the year, which is a great segue into our sort of Fed tracker tool, the 2-year. The 2-year is laughing in the face of Jerome Powell still. He cuts by 25 basis points. The 2-year rallies a bit higher. So just kind of funny that relationship continues to be expressed here. But if we move on over to the Fed tracker tool, the biggest thing I want to call out is really just the way that the terminal rate, if you will, or at least what the forecast goes out to December of 2025, has really been bumped higher from 325 to 350. Then it moved, of course, 350, 375, and now it's currently sitting at 375 to 400. And the reason I think you want to pay attention to that is because the updated SEP from September really projected for 2025 a 3.4, right? So a 3.4 means that we should be hanging out in this zone down over here. And the fact that the market's saying, no, not really, to me, continues to just, in the back of my mind, keep the inflation story going. The market's somewhat worried about inflation, which is another great segue into what was sort of said in the press conference from Jerome Powell. He sort of acknowledged that the inflation you're continuing to see, which is shelter inflation and in some senses insurance inflation, is sort of a lagging measure of inflation. And I think he has a good point, but I'm not sold on the idea that inflation is completely dead. The point that he sold is just that shelter and insurance, because of its renewal period, right? Obviously, you're talking about annual on, rents or owner's equivalent rents, people getting into new mortgages. That's only going to increase very sporadically. You're not going to have an even flow of data there. It's lagging data, if you will, because of the way that leases turn over. For insurance, it's very similar, right? You sort of get your deal once a year and you're done with it. So with that, I think there's a point, but I'm not convinced we're all the way out of the woods. I do think that the market is still somewhat pricing in a resurgence of inflation, and we'll just have our answer here on the Wednesday session, right? Wednesday at 8:30, come out to the pre-market prep here live on the channel up in the penthouse. We will have coffee and donuts on me. But we're going to get CPI, and that's where we're going to find out yes or no. Is shelter inflation still an issue? Is it continuing to progress higher? What are the other sectors, or components of CPI doing? Is insurance inflation continuing to be out of control? Is goods inflation coming back? Is services inflation outside of insurance and shelter coming back? And that'll be a big tell here for how the market responds. I could imagine, just to give you sort of I don't want to be overly prescriptive, but if inflation comes in hot, I would imagine that the market does not like that all that much, right? And the market does see a move in the downward direction, throws a little bit of a temper tantrum, right? So be prepared for that on inflation. That's Wednesday at 8:30. We will cover it live up in the penthouse. Keep in mind that the market is, I shouldn't say the market, the bond market, fixed income markets are closed on Monday. So if you trade in a cash account, you might not have settled cash for Monday. Just a logistical thing to keep in mind there, okay? Let's take a look at earnings insights. One of the things that, as we're talking about a 10-year that's continuing to rip sort of in the upward direction around that 4.3, we're still seeing a PE ratio, historically, as elevated as it's ever been. The historic 25-year PE ratio is somewhere around this, 16.25 or something like that. So if I scroll up, we can probably see it. Where is it? You can read here as I'm continuing to talk to you. It's got to be somewhere. This is going to drive me nuts if I don't find it. Where is it? We want a 16 point something. 16.5. 16.4. There we go. That's the 5-year? No, 25 years. 16.4. Sorry for the real-time reading of the document. I should have had that prepared. But as the PE ratio continues to expand, with interest rates also moving higher and the continued fear or somewhat skepticism of inflation coming back, you have to imagine if Jerome Powell sees a hot CPI print in the next report, Wednesday, He explicitly said in the press conference on Thursday, I'm about to say Wednesday, on Thursday, that they're willing to go into a pause. They're continuing to remain, holding true to this data-dependent approach. So just something to keep in mind. Historically elevated PE ratio, 10-year continuing to break in the upward direction. If you look at the actual sectors here, look at technology. And I think one of the things that you have to keep in mind is the NVDA PE ratio and the way that is, being influenced here. That's huge. That's huge. I'm not saying it has to come back down to the 25-year average. There are certainly reasons why it might be elevated here, but generally speaking, if these things do cool off, if the 10-year rate continues to move in the upward direction, if CPI is hot on Wednesday, I could imagine a world in which we have this big rally that we just got, right? And even just a slight pullback there, it's going to cause some panic, but this is sort of the logic, the underlying fundamental logic behind why that might take place. I'm not betting on this. I'm not making a big short in the market because I think this is going to take place, but it's something to just keep in the back of our heads when we're thinking about the narrative of how markets are moving overall. As we're looking forward to the earnings reports this upcoming week, what do we have in terms of honorable mentions? Shopify will be interesting because of the way that they obviously represent somewhat consumer spend, of course. How are stores doing? If you look at Home Depot, that'll tell us a little bit about the cyclical side of the economy. Kava will be interesting. Kava's been a huge watch for a lot of people recently, so curious about that. Oxy, not as interested. What else? Cisco maybe here after the close on Wednesday. HUD 8 mining, that'll be interesting for crypto on Wednesday before the open. We'll watch out for some potential movements there. You can see Bitcoin Depot. Interesting. I didn't even know that was a thing, but there you have it. What else is going on here? Walt Disney before the open on Thursday might be an honorable mention. I would certainly call out Applied Materials. We'll see how the SMCI madness, if you will, impacts the actual orders from AMAT, right? So if that sort of sees a downtick, it might be slightly telling. That's really the honorable mentions that I would call out here. A lot of people have been watching ASTS Space Mobile. Maybe worth a watch, but for me, it's just a popcorn watch. It's not really something I'm interested in trading. Everything that you see a box around other than that might be interesting. And this is not my box. That is their logo there for Curl. So anyways, that is the earnings calendar. Let's get back on over to the platform. Let's finish up this weekend's analysis with a look through the risk appetite charts. Here is the TLT ratio to the S&P. Downtrend means risk on for equities. Here's the bonds relative to one another, continuing to signal, okay, we're a little bit fearful of inflation. I will give credit where credit is due. I mean, you're starting to stagnate on the longer end of the curve, but the shorter end's still in an uptrend here. So those inflation fears still somewhat elevated. Let's take a look at credit spreads continuing to absolutely plummet, dropping like a rock here, which would just be indicative of volatility getting crushed. Not a big surprise on that. That's bullish for broad markets. HYG is playing nicely, so junk bonds getting a higher high here with a huge breakout in the broad market. I like that, but obviously just from a relative perspective, you're still underneath this pivot, whereas the S&P is clearly much higher. So broader divergence, but bullish in the shorter term sense from here up to the end of the week. Let's quickly take a look at Bitcoin. And you can see here the breakout continues, still risk on. I would argue that this is bullish in terms of the risk appetite for equities down below, general risk taking in financial markets. Let's take a look at breadth, which is moving back in the upward direction. Beautiful hold of the 50% mark out of the 50 SMA, hold of the zero line out of new highs versus lows. This looks fantastic. I will just quickly call out that on the Wednesday gap up, right, that of course provided a spike, much more of an equal high. If we just go back out to the weekly look, it's a slight lower high, but understand on Wednesday when we got that big gap up, yes, there was a huge number of new highs versus lows, right? So that's bullish for the market, I would argue. Let's take a look at the RSP, what's going on from an equal weight perspective. I like the hold outside of the previous all-time high. It's making sense to me that the breadth is expanding as this breakout's taking place. Same thing with the equal weight NASDAQ producing brand new all-time highs. If we look at industrials versus transports, hallelujah, transports finally broke out of this multi-year range. They're sort of giving a little bit more confidence to the new all-time highs in the industrials up above. Remember, you can make stuff, but if you're not moving it around, it's a little bit of a disjoint, right? That's the classic sort of story between those two. If you take a look at volatility, as we expressed with credit spreads, no surprise that it's lower. All of the event risk from the election, all the event risk from the FOMC is completely out of the market, so no issues there. No issues in the VVIX moving lower here underneath 103. And the most important, perhaps, is whether or not the backwardation or the contango is going to resume. And you can see here, I mean, it's the chart The chart speaks for itself. So many of these charts really speak for themselves. Huge move higher once the election risk was sort of evaporated, and now we're back into a stronger contango, which means that there's less risk in the present day than some unknown future. That's the exact situation you want to be in if you're a money manager allocating capital. When that's inverted, right, then you see a restriction of capital flows into the market. 9 versus 30-day VIX agrees, and the 1-day is sitting on the lows as well at 745. Let's take a look at the core list of companies here, and then we have 2 additional trade ideas to share with you. Apple is honestly a relatively weak name considering what's happening in the broad market right now. On the Wednesday session, most notably, it did produce an inverted hammer underneath the bottom of what I would consider a balance range right here. So I thought it was looking a little bit better for a rejection. Thursday says no, we're back in the midpoint of this range. I've got mixed feelings about Apple, if I'm being honest with you. Yes, there could be a thin structure retracement through some of this, but the relative weakness, the fact that it's struggling now at the daily 50 SMA, the fact that it had gone on to produce a lower low, to me, I'm sort of really open-minded actually to the possibility of a lower high. Do I want to be aggressively shorting Apple as the broad market's very strong? Probably not, but I think the flip side of that same exact coin is just I would probably look elsewhere for better long opportunities. Let's take a look at Microsoft. This is a great looking chart simply because we have a gap structure to close overhead. I like the strength on the follow through from Wednesday, Thursday, a little bit consolidation on Friday. As long as it's over the 2 key moving averages, 50 SMA in blue, 200 SMA in green, as long as we're over that, it's just a bull flag to close the remainder of the gap up here over 426.80 to 432. If we knock it down to the hourly perspective, right, a very, very good looking trend. Here's a balance range, break, higher low, break, potential for higher lows. Anything that's over this 420 mark, right, just bullish consolidation. There you go. Big spark. Shout out to you in the morning show. Let's go ahead and jump on over to NVIDIA and take a look at what's going on with NVDA, the one stock to rule them all. Bullish consolidation over the previous all-time high. There's not much else to say other than bulls on parade. Any consolidation up here over 144.42. Brigade bolts over the new all-time high, blue sky territories. Earnings are not this week, but a little bit further out in November for NVIDIA, so keep that in mind. But generally, really great looking chart here. Let's go down to the hourly and just point out that you do have a flush point at 146.25, so if you do break below that, I wouldn't, again, the short here, the risk reward doesn't seem all that favorable, trying to pick up this very small move A to B. But if we do break below 146.25, just let the pullback go and start looking for those longs, I would say more appropriately, at 144.42. So just calling out the way that this low is very equal to the low of the Thursday open as well. All right, there's NVIDIA. Stronger shorts, yes. If there's something that looks like this, the gap close can be a target on a lower high here underneath that previous all-time high. Back to the daily, we'll take a look at Google. Decent 100% retracement. This thing's all over the place. It's a little bit better of a swing trader stock as of right now. It's really been that way for a while, but trading back into this equal high. So 100% retracement of the downdraft after the earnings gap up. So it's kind of all over the place, but the 100% retracement to me would suggest that it would be ideal to spot a higher low first and then attempt the equal high breakout. It's very rare that on a 100% retracement, you just go straight through that move, especially given the magnitude of what's happened here in Google. So I'm really looking for consolidation to remain over 176.25 to then look something like this for continuation towards that all-time high. No need for the hourly chart on that one. Pretty straightforward chart. Amazon, no need for the hourly here either. Maybe we'll look at 206, but I mean, speaks for itself. Brand new all-time highs. Thanks, Beth Jesus in the chat. Huge breakout, consolidation over 206 is great. Brigade bolts into blue sky territories. If it does break below 206, maybe there's enough range there intraday to short it. But again, keep in mind that you don't want to overstay your welcome at $200.25. Previous all-time high is usually a really strong location for a retest higher low, right? Very classic Brigade bolt. There it is. So that's what I'm watching for. Here it is on the hourly, just to point out the 206 level. It's the breakout level from here. And you can see the nuance of this 209.50. This is very nuanced, right? If you're a day trader, maybe this means something to you, but as someone who's really just using the daily charts and the analysis from there, a little bit less important there at 209.50. So that's what we've got on Amazon Metaverse. What's going on here? Daily time frame chart, really just a balance range, right? You've got a wall-to-wall move, 100% retracement. I like the 3-bar play that's brewing here on the daily. If it can continue to stay over 584, I think it's a very clear chart to navigate going forward, something along these lines over 599, and it's rock and roll to blue sky territories. As I zoom in here, look at the hold. on Friday, right? So great looking support over a prior technical level. As long as we stay above, good to go. This is sort of the trade that we're looking for. If you could spot another attempt here, you could try the risk reward for something that does this first to the high of day from Thursday and then balloon runners into 599. Heck, if it breaks beyond that, you really got some strong runners. The only time I would be bearish is if this does break below. You sort of have a lower high double top under the neckline. The only reason I would entertain this short is because of exactly what's going on here. You guys know me. I'm a sucker for this thin structure stuff. If we're underneath 584 with a lower high, I think maybe there's an opportunity to retrace that a bit more firmly to 574. Even when we get there, from the daily perspective, you could search for a higher low, right? If this is a balance range, it would just be constructive to continue to set higher lows on the daily up and over the top of that. That's 574. Next up, Tesla. We gotta talk about Tesla. Unbelievable. Honestly, I gotta sort of be transparent here. I didn't capture any of the move on the Friday session. It was off to the races as soon as Friday opened up. The only thing I can do is sit back, not try to chase things if the risk reward's not appropriate. And this is sort of like a side tangent here to say, if you're someone who misses some moves sometimes, which is reasonable, right? If you're looking for a higher low pullback intraday risk reward entry, you're not always going to get it. If you want exposure to things like this is sort of a selling point for, I should be careful, selling point as in like a convincing point for having a long-term portfolio. Did I miss the intraday action on Tesla? Yes. Am I exposed to it in my long-term account? Not just by like S&P 500 exposure, but in general, like Tesla longs. Do I have 100 shares of Tesla tucked away plus? Yeah. Right? So it's not the end of the world to miss it intraday if you have that exposure. And I think from a trader's perspective, this mindset is really useful because it won't cause you to FOMO into things. How many times have we all been burnt by FOMO, right? If you can eliminate that FOMO emotion, maybe this is just some justification on my part. I'm getting emotional about missing Friday. If that's your approach, then fine. But the sort of tangible takeaway here is if you have a long-term account, if you've got exposure to some of these names, I don't think you should ever necessarily feel bad about missing an intraday opportunity. That's just my 2 cents. So again, maybe some self-justification. Comment down below what your take is. But chart looks bullish. There's nothing bearish to say about this. Obviously, you're over these pivot highs. You have nothing but upper targets to be reaching towards. Even on the intraday, let me take this down to the hourly, and not even the hourly. Let's go to 15. 15? No, we don't even want a 15. We want a 5. I just want to show you how beautiful like previous historic levels are. Tesla's been really respectful here. This 312 mark was actually a historic level that we have from like years ago. The fact that Tesla intraday broke that level, found support above and continued, very, very bullish, right? To me, that's just a pure play example of the technicals working out beautifully. And, kudos to anybody who sort of took that, right? So Tesla, upside, bullish, can't really argue that it's a bearish looking charts, is now the best time from a risk reward perspective to be getting involved with new money longs. You're sort of buying the tippity top of the move. Could it always continue? Yes, I would say if you're going to try it, you've really got to look for two things. Either a Brigade bolt over this 332.25, or if it pulls back, undercuts, and supports back above 312, you could try a long here, right? Those are sort of my two outcomes. I'd be cautious in the midpoint of this, noting that it's rallied substantially. Just loading up brand new money longs here. Risk reward wise, I think it's poor form. It's poor form as a trader to just arbitrarily long it, right? As an intraday perspective. Longer term traders, yeah. If I acknowledge, I know we're spending a lot of time here on Tesla, so don't worry, I'll get off of this soon. If you're looking at the weekly perspective, you have a break of the resistance trend line, a retest happening here. You've got a breakout over this. The weekly could just be getting started. It could be going back up towards all-time highs. So from a higher time frame perspective, if you're going to use a looser stop, then sure. But if you're trying to scalp this intraday, if you're trying to trade this up here towards these highs, a little tough to justify risk reward at the tippity top of the move. So enough about Tesla. Thrilled to have participated in previous moves on Tesla, but this one kind of a nail through my heart on that Friday session. Let's take a look at JP Morgan. I'll knock this thing back down to a daily. Inside bars, just like the XLF, keep it simple. Consolidation here builds out technically a descending triangle. Let it close the gap, looking for the previous all-time high to act as support, 226. If it's just in the range, I would just be bullish for the S&P 500, not necessarily looking to trade JP Morgan in that range. Obviously, a blue sky breakout speaks for itself over 248. Netflix, mind of its own. Here it goes, right? We know what happens. Here's the earnings season. Here is post-earnings. Here's the earnings season. Here's post-earnings. Here's the earnings season. Once it makes up its mind, there it is, right? So there's earnings. Maybe it's going to make up its mind and go for a continued rally. Remember that in the past we've talked about this rally usually lasts for like a solid, 3 to 5 day sessions. So we are already printing 2. I'm not saying it only has 3 more left, but generally speaking, I think if Netflix is going to run away with it, you sort of want to be involved in the next couple of rallies and not sort of push your luck beyond that. It goes into these phases of consolidation and chop, right? Consolidation, even a gap down for that next earnings cycle. So just something to be mindful of. In terms of the intraday on the hourly, chart looks great, right? Strong move on that Friday session. Next up, last but not least, AMD before 2 additional ideas for you. AMD's been a laggard, obviously, to NVIDIA. We've talked about this over on X. We've talked about it here on YouTube, but why would you want to buy this? Why would you want to try to long this? Maybe it has a catch-up trade in it at some point, but it's clearly a laggard to the semiconductor space. I don't know. It's not really a top-of-mind trader, trader for me into this upcoming week. Maybe I'd be interested if we start, interacting with the gap that's 153, 158.75. We're just not there yet. So if it wants to turn into a big double bottom, great. We'll watch out for that trade over time. If it's just consolidating over here, I think it leaves a little bit to be desired. Here it is on the hourly chart, right? So a great little Stevie Wonder on Thursday, but beyond that, really could not, get in gear or stay in gear. And one maybe positive takeaway is that it's staying over the origin of this breakdown bar on Friday. So if it's over 147.75, maybe you get this retracement to 153. But to me, it just becomes, why would you trade that if you could trade NVIDIA, which has been moving much more respectfully recently? So that's AMD. That's the core list of companies. 2 trade ideas for you. First one is on CRWD. CrowdStrike should be familiar. We had talked about this massive sort of, here it is back here, the breakout over 300. Nice consolidation getting in gear on the gap up from Wednesday, of course, just like everything else in the market, but there's more thin structure to retrace. You have an inside bullish bar on the Friday session, closed as a hammer. If you take it down to the hourly, you can see this. There was a retracement of this end of day rally on Thursday, but then we rally back into the end of day on Friday. So if we can take out these highs, if we could take out 335.90 back on the daily chart, you can see this as the low and the gap close there. I think it's a continued story of thin structure retracement into 352.30s. You guys know me, round numbers only. Who let that one slide? Probably me. Guilty as charged. 352.30 and then 367 is really the top end, or I should say the bottom of the top overhead supply, right? This range from back here. So looking for some CrowdStrike upside lift. This is in play as long as we're over Wednesday's low. As long as we're consolidating here, it's a constructive building block in the upward direction, looking for the trend to continue higher over time. That's CrowdStrike. And then lastly, we have EXPE. Is it Expedia? Yeah, Expedia. It's got the E at the end. This is a counter trend opportunity that I need you to understand your trading personality about. If you're looking at this chart and you're foaming at the mouth and you're saying, oh, look at that short, I would agree with you, right? There's the opportunity that this thing has gone parabolic. Maybe it's not justified on the earnings gap up mixed in with the election volatility, the FOMC volatility. It did produce a nasty inverted hammer. You need to be willing to respect a tight stop, though. So if you knock this down to the hourly chart, I would really, depending on what structure builds out early in the session on Monday, if any at all, if it's not just like straight down through the gap, I would start thinking about this level right here at 184.60. Sorry for not doing my homework ahead of time. But if we can stay below that, I think the opportunity is there to continue watching for this gap close, right? So that's going to be here into about, 174.25, we'll say, for round numbers' sake. And that would be your target. If this finds its way up here, you can't just continue piling into a short. You can't just say, oh, no, look at the daily inverted hammer. It's got to go lower. It's got to close the gap. It's parabolic. It's got to go lower. If it's over 184.60, which is that intraday level that we just saw, I could even, go further to the 5-minute. You can see how that, I didn't pick that number randomly. You can see why that's the level. If it's over that, then it might be over for the possible short. You might just get sideways consolidation. So yes, I do think that there is a short opportunity here with the nasty upper wick. Heck, one of the common traits of these sort of trades is the Bollinger Bands, right? Let's just throw that on for the sake of fun. Well extended beyond the upper bound of the Bollinger Band. So is it possible that this pulls in a little bit? I think the answer is yes, right? So that's the general sentiment of Expedia. Let's get those hideous Bollinger Bands off of there. It's not something I use at all. So anyways, something to consider as a possible short. That's all. If the broad market pulls back, if it's like, oh my goodness, it is going to turn into a big fake out, if the election gap up starts fading and Expedia is just still sideways up here, it's probably a decent opportunity to look for something like that. But would I continue trying to short it up here? No, not really. Absolutely not. So I wanted to give you one long, one short, CrowdStrike and Expedia here, and that's going to wrap it up for today's episode of the weekly watch list. If you learned anything new or enjoyed the show, let me know down below in the comment section or by giving the video a very simple thumbs up. We will be live on Monday morning. Remember that the bond market is closed, fixed income is closed, but the equities market is open. Futures will be open, so we'll do the pre-market show there on Monday. We hope to see you there. That kicks off at the 8 o'clock time frame, Eastern time. And with that said, have a green trading week, and I'll see you in the next one.